Welcome back, folks, to the 10,000 foot view that we're going to take looking at macro details in the economy. Macro, what does that mean? That looks like rolling up to a house, looking at it from the curb view, and pointing out maybe the imperfections or the good and the bad about the house before you purchase it. The micro, getting in the nitty gritty, would be jumping into individual companies or jumping into individual room and see if it needs to be renovated or does it need to be a complete rehaul in the kitchen. There's areas in our lives in which we operate that way, but today we're going to be very macro focused, big picture, and just walk through a couple things: the economy, oil, S&P, and a little bit of what to expect for the midterm. So, investing in companies you believe in should be the first thing you think about when someone says, "What are you investing in?" Should be something that I believe in, I trust in. It's far better. This is a Warren Buffett quote. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So cheap companies or cheap purchases do come from time to time for wonderful companies. And so you get a wonderful price and a wonderful company. However, that's very far and few between. And what a lot of people do is they buy wonderful companies at fair prices when they have an opportunity to do so. Now, that doesn't mean you go buy the biggest and baddest thing. You don't buy everything in the market that has done well forever. Warren Buffett said this back in 1989, and it holds true today. So let's jump through and kind of talk about what that might look like. So when we look at the economy, we look at a few things. Big picture. Is our economy growing? Yes or no? Well, if we have a quarter over quarter growth and then we project that out, the projections last year were somewhere in the 4 to 5 range as a high end possibility, probably more like 3% on the high end would be a realistic possibility. What it's annualized right now is 2%, as you see. Real simply put, if you have 2 quarters of negative GDP, you're in a recession. Recessions sometimes happen and people don't feel it. Sometimes recessions come and go before you know it. And it's really a backward looking indicator on what's happened. But we can see that as of January and going into the second quarter, which we're in now of 2026, GDP is growing at 2%. We don't expect there to be a big fall. Now, one thing I said back in, I think it was December, maybe earlier in 2026, was if you have oil persist at the rate it's going, it could affect that number. And it has. It's brought it down by about 0.2%. Okay, so if you're not into the nitty gritty weeds of it, ignore everything I said. Understand that the economy is growing. Just keep it simple. But if you want to dive down deeper, oil will have an effect, and that can persist longer, which could throw us into a recession 12 to 18 months out. It just depends. It's a shockwave effect. We don't know when that happens, but there's some indicators that suggest that might be a possibility. Now, if we look at a midterm election, we talk again macro trends, looking at the market. If you are looking at, and I know I'm blocking a little bit of this, if you're looking at this chart, what we really want to take away from this is average years, all other years. This is what the S&P 500 has done on average since 1931. It's up. You can see 9-10% at the very end up here. Now, if we look at what we're doing now, we are sometime around in the early stages of May. So I don't think we're on the back end because actually we have kind of done this V-shaped recovery. It's pulled forward. So it's probably in the middle here, which means we're really probably right here with this little bounce. So let's say we change and we stretch this chart out a little bit. I don't know what gets us from this point up here to down through October, which is right here over my shoulder. I can't tell you what's going to happen. The midterm election year typically looks like that. Once we know who the candidates are going to be and we have a better determining factor after September, October, it seems to rally towards the year end, and we finish somewhere around 6%, on average about 6%. So in all reality, September is one of the worst months of the year historically to have a good return. So if it's a negative, that's not a surprise. But everything in the summer, we could see slide. So just be aware of that. All that means, if you're retired, is you should stay invested. We have a reason to stay invested. We don't need to panic. And if you're investing in your early years, mid-cycle careers for our folks that do, then you're looking at buying in the whole time. Chunks, dollar cost averaging, whatever it may be, over the entire summer. So I would not think twice about staying invested or keeping some money and cash on the sidelines so you can buy an opportunistically. All right, so if we go pull forward a little bit, S&P 500 is what a lot of people use to measure. It used to be kind of the Dow. That's the Dow 30. Then we have the S&P 500, and then we have NASDAQ. And NASDAQ is, 2 or 3,000 or 1,000 companies. There's different measurements. Maybe there's 100 companies in some of the measurements. But when we look at the S&P 500, one thing I want to be cautious of, I want to tell you about, I have people all the time and say, well, not all the time, but I've had conversations. Why would I invest with an advisor? Or why should I buy anything but the S&P? Because it's done at the average 10%. Now, I'm going to tell you that there's better and bigger uses of your money elsewhere, not just buying the S&P 500. Here's why. These are the circles of the S&P 500, all the sectors: industrial, material, consumer, technology, healthcare, utilities, energy, real estate. In those, you have some of the bigger players. Cat's a big one, obviously, in industrials. There's several over here in materials that have some big players, but the ones in white circled here are the biggest ones in their categories, and they also hold the biggest weight in the S&P, meaning the S&P 500 is 40% weighted on 13 companies. So these 13 companies that are holding up the S&P 500, at least 40% of the valuation, that's a bit risky. So when people say they're putting it in there, they're really being pretty concentrated in 40 positions, or sorry, 13 positions with 40% of their money. So it's not something that I'm saying is bad. What I'm simply saying is there's better ways to spend your money than continue to buy into this and think this is where you're going to get all the biggest and baddest returns. It's actually contrary to what the opportunity is to be in individualized names, and what you buy should be a wonderful company at a fair price. And sometimes buying into the S&P is not a fair price. And sometimes they're wonderful companies, but the pricing is out of whack of where we're headed. Now, not doom and gloom on it. I just want to persistently coach against anything that's going to come up against S&P 500 when people say, well, I can just throw it there. I promise you there's a better way to manage your money, but it's not a bad place to hold. We hold that in clients' accounts, just not a large amount. So if we shift our focus over from the economy and we shift it to a little bit of stocks with the S&P and what the S&P has done in the midterm election, there's a lot of things in the economy or geopolitical that affect our stock market returns just because it's headlines. And then you look at S&P and you see over concentration. You can see how those three things kind of go together. Economy is growing, but just one tweet can push things down, because if 13 of those companies decide to sell off one day, we're following that trend. And that's not how we like to be aligned with our investments. If we look at something that we all are feeling at the pump, this is crude oil. Now, the reality is it's coming down, and this is a new number as of this morning when I pulled this chart. But at the end of the day, we've had some huge spikes and pull downs. There's a lot of volatility. But as we anticipate the war with Iran to come to an end at some point in the future, oil prices and the future contracts are expected to be around $80, $75, $85, $80 by August or September. That's fine, but that's still higher and will take longer for it to trickle down and settle out than where we were at. Now, down here in the 50s and 60s, that's just too low for what the demand is in oil. So we had a mispricing anyway, but this giant rip up is not what we would expect to see, maybe at equilibrium, right? A balance of where this should be, which could be somewhere around the upper 60s and lower 80s. We went way above that with some fear, right? That's really what drove this. Now, if this persists longer, it could have a lagging effect on the economy, and then we drag ourselves out of a positive GDP range into negative, and it could put us in recession. Probably not likely, but if it goes 150, $200 a barrel of oil, then yeah, we would be there. But right now, that's not what we think is going to happen. It's always a possibility, but we don't think that's where we're headed. Okay, so this is something I want to kind of finish with. If we're looking at the S&P 500, again, it's just a way to measure how companies are doing. It basically shows that 82% of the S&P 500 reporting firms are topping or above the estimates, and 78% of those firms are posting year-over-year earnings growth. What is earnings? Earnings essentially is the growth of a company, and we measure that in earnings per share, how many shares they have outstanding, and then what was their earnings, how profitable they were, what kind of revenue they did, what were their costs. And we're seeing that expand. And when you see an expansion of earnings, think of that as you're earning more money per hour that you work. And if I told you that every client I work with is up 10%, every hour they work, they're making 10% more money than they were last year, that's kind of a similar way to look at this, in the sense that when we see that in companies, we think, oh, that's strength. That's good. That's a positive number. And so we don't need to be fearful. The chart I showed you with midterm election, things can slide, but we have good, solid companies making good, solid returns. And so we want to buy into the specific ones that make the most sense. Not all of them, but specifically, there's a good way to go about it. Again, talked a lot about the S&P 500 and talked against people putting all their money in it or just being overly concentrated in that ETF or index. It's because people don't know where else to put the money. And that's really where you earn your keep, is understanding how to invest in different companies. Not just this. This is not saying this is the only place to put the dollar, but there's better use within S&P 500 individual companies and other ones that maybe aren't measured in the S&P 500. There's great places to put money. So bottom line, 178 companies reporting. Out of 178 companies reporting, 147 exceeded earnings per share expectations. Some fell short, some were in line. But again, year over year growth by the majority and exceeding expectations for the majority is a strong sign to show you really shouldn't be panicked about the markets. You should stay invested. So, as we take a macro view, and I dove a little bit into some of these things, we really want to focus on the economy's growing. Oil can persist, but we should see it come down just overall. Okay, it takes time, and it'll take time for that to see at the pump. And then S&P 500 earnings are showing strength in those companies. And there's other measurements to show the economy is supporting growth in these companies, which then supports the stock market. Okay, that's not always equal, but that's how it's worked out to be. So stay invested. Give me a call if you have any questions. Hope this was helpful. Look forward to chatting with you guys soon on the next 10,000 foot view. Have a great day.